Well, good morning and welcome to the Reserve Bank. With me, I've got Grant Spencer, and as you all know, Grant is the Deputy Governor and he heads all the financial stability work in the bank. New Zealand's financial system remains solid, remains sound. The banking system is well capitalised. Funding and liquidity levels are above required minimum levels. The volume of non-performing loans continues to decline, and stress tests of the major banks' portfolios indicate that the banks have considerable capacity to manage various shocks. The financial system faces four key risks. We reported on these in the May Financial Stability Report, but the balance of risks has shifted in the last 6 months. The four main risks relate to imbalances in the housing market, high indebtedness in the dairy sector, the implications of a slowdown in Chinese growth, and the banking system's reliance on offshore funding. Pressures in the housing market have eased since the introduction of loan-to-value restrictions and the rise in interest rates. We've always indicated that the LVR restrictions are a temporary measure. We welcome the reduction in house price inflation and the slowdown in the growth of housing credit. We also welcome the increased residential building. But there remains a risk of a resurgence in house price inflation, especially with the strong immigration flows. Consequently, we don't consider it appropriate to ease LVR restrictions at this time, but we will continue to monitor the housing market closely. Let me hand over to Grant for his comments.
So while housing risk has reduced, risks in the dairy sector have increased. Forecast dairy payout for the coming season has been reduced significantly and could result in rising loan defaults should the lower payout level persist. Lower dairy prices are in large part due to reduced demand in China, highlighting New Zealand's vulnerability to a slowdown in the Chinese economy. Risks arise both from New Zealand's large volume of trade with China and also from any broader financial market disruption that could result from a Chinese economic slowdown. The other key systemic risk is the banking system's reliance on offshore funding, and this has reduced in recent years, but the banks remain susceptible to volatility in international funding markets. On the regulatory front, the bank is currently undertaking a stocktake of its regulatory framework to improve its efficiency and clarity. Initiatives are also underway to better measure and define bank capital adequacy. And these include a benchmarking exercise for the large banks' internal capital models and the development of a comprehensive stress testing framework. And finally, a review of outsourcing policy for banks is also underway. Thanks.
Well, thanks very much. Very happy to take your questions. So we would like to see house prices over the long term, and this is really talking about the long term, increase no more than the rate of nominal income growth. Now, hopefully, as we start to get the supply response coming in terms of increased building and the special zones up in Auckland and the like, we'll see some better balance in the housing market in terms of the supply and demand.
And just a point of clarification on timing, I think in May you said that the restrictions would go at the end of this year at the earliest. Are you able to say, is it the middle of next year at the earliest?
No, I don't think we can give a specific time, but what we can say is we've always seen these as temporary measures. We don't want these to be permanent measures. But what has surprised us, we've been very pleased about the deceleration in house price inflation and what's been happening with housing credit growth. But the migration has been a surprise. I think it's been a surprise to all forecasters. And that's something that we'll be looking at closely.